What's going on, my traders and future traders? This is your man Coach Allen, back again with another video. Today we are talking about trader terms and terminology. If you're having trouble understanding the lingo because you've heard so many different names and terms from all these different YouTubers, this is the video that you want to stop and watch. Listen, if you're trying to learn the futures market, you don't need a PhD or a dictionary the size of a brick. We're going to break these terms down simple enough that even an 8th grader can understand. It's going to be simple, straight to the point, and strictly focused on futures. I repeat, strictly focused on futures. So we're not talking about options. We're not talking about crypto. Where's Waldo? None of that. Strictly focused on futures. So pay attention, grab your notepad and a pen. Let's get into it. Futures contract. This is just a legal agreement to buy or sell something like gold at a specific price on a future date. Think of it like this. I live in Florida. The gas right now is like $4.16. Let's say I need 20 gallons of gas for my car. I'm going to pay for the gas today, but I'm not going to go to the gas station and pump it until tomorrow. So right now today, I'm going to pay $4.16 per gallon of gas. If the price of gas happens to jump up to $6 tomorrow, I've already locked in my legal agreement to pay for 20 gallons of gas for $4.16. So that's what I'm going to pay when I go to the gas station tomorrow. E-mini contract. This is a standard electronic futures contract that is a fraction of the size of the old school full contracts. For gold, it's a way to trade the big moves without needing $1 million bank account. Micro contract. These are the baby versions of E-minis. They're usually 1/10 of the size. So for the E-mini contract on gold, a tick is $10. For the micro contract in gold, a tick is $1. Micro contracts are perfect for beginners because they let you practice with real skin in the game for much less money per tick. Commodity. This is just stuff that comes out of the earth like gold, oil, or corn. Assets. This is just a fancy word for what you're actually trading. Whether it's gold or the S&P 500, the asset is the thing the contract is based on. Margin. Think of this as a security deposit you give the broker so you can trade. It's not the full cost of the gold, it's just the cash you need to keep in your account to hold the position. Leverage. This is the superpower of futures that lets you control a lot of gold with a little bit of money. It's great for profits. Points. This is a whole number move in the price of a contract. If gold goes from 2000 to 2001, that's 1 point. Ticks. A tick is the smallest possible price move a futures contract can make. I have a strategy that I use when I trade called the runaway train strategy. I'm looking to grab exactly 20 of these ticks. Tick size. This is the minimum step the price can take. Tick value. This is the actual dollar amount you win or lose for every tick the price moves. For micro gold, 1 tick is $1. For the mini, 1 tick is $10. Bid. This is the highest price a buyer is willing to pay for a contract right now. Think of it like the starting offer at an auction. Ask. This is the lowest price a seller is willing to accept. If you want to buy right this second, this is the price you're going to pay. Volume. This tells you how many contracts are being bought and sold. High volume means the party is. Low volume means you're standing in an empty room. Volatility. This is how fast and crazy the price is moving. When there's high volatility, that means that the price is actually moving good. When it's low volatility, you can be stuck. Liquidity. This is how easy it is to get in and out of a trade without the price jumping away from you. High liquidity means there are plenty of people to trade with. Long. When you go long, you're believing the price of gold is going up. You buy the contract now, hoping to sell it later for more money. Short. This is believing the price will go down. You sell a contract you don't own yet, hoping to buy it back cheaper later and pocket the difference. Long position. This just means you currently own a trade that profits when the market moves up. Short position. This means you're currently in a trade that profits when the market moves down. Expiration date. Unlike stocks, futures contracts don't last forever. They have an end date. If you're still holding when this date hits, you're cooked. Rollover. Since contracts expire, traders eventually have to hop from the old contract to the new one. It's like upgrading to the next model of the same car so you can keep driving. Gap. This happens when the price jumps from one level to another without trading in between. It usually happens when the market opens way higher or lower than it closed. Gap up. This is when the market moves at a price way higher than where it closed the day before. It's like the price took an elevator up while you were sleeping. Gap down. This is when the market opens much lower than the previous close. It's a literal hole in the chart where no trading happened because the price tanked so fast. Entry. This is the exact moment in price where you click the button and get into the trade. In my runaway train strategy, this happens right after a strong close outside the station. Exit. This is when you get out of the trade, hopefully with 20 ticks in your pocket. It's the end of the ride, whether you hit your target or you get stopped out. Market order. This tells the broker, I don't care about the price, just get me in right now. It's the fastest way to get on the train, but you might not get the exact price you saw. Limit order. This tells the broker, only get me in if the price hits this specific number or better. It's like waiting for a sale at the store instead of paying full price. Stop loss. This is your emergency brake that gets you out of a trade if it goes against you. I use a 20 tick stop to make sure one bad trade doesn't blow the whole account. Trailing stop. This is a stop loss that follows the price as it moves in your favor. It trails behind the candlestick to lock in profits as you go. Fill. This is the confirmation that your order actually went through. It's the receipt showing you're officially in the market. Candlestick. This is a visual way to see what price did during a certain time, like 5 minutes. It shows where the price started, ended, and how high or low it went. Wick. These are the thin lines poking out the top and bottom of a candlestick. They show us where the price poked its head but couldn't stay before the candle closed. Bullish. This means the market is looking strong and prices are going up. Bearish. This means the market is looking weak and prices are heading down. Bulls. These are the traders who want the market to go up. Bears. These are the traders who want the market to go down. They swipe the prices downward. Bull market. This is a long period where prices are generally going up. Bear market. This is a long period of falling prices. Paper trade / demo trading. This is trading with fake money to practice your strategy without losing real cash. It's like a flight simulator for traders. All the practice, none of the crashes. Slippage. This is the difference between the price you wanted and the price you actually got. It usually happens when the market is moving way too fast. Broker. This is the company that gives you the software and connects you to the market. You give them your money and they let you click the buy and sell buttons. Prop firm, short for proprietary trading firm. These companies give you their capital to trade with if you can prove you're a disciplined trader, usually through a test. Most of the times they're called evaluation tests or evals for short. Trading hours. These are the specific times the market is open for business. Trading sessions. The market day is broken into parts: Asia, London, and New York. Strategy. This is your game plan or set of rules for trading. Analysis. This is the work you do to decide if a trade is good or bad. Market open. This is the official start of a trading session. It's usually when the most noise and movement happens as everyone rushes in at once. Market close. This is the end of the trading session. Prices often settle down or make one last crazy move before the lights go out. Support slash floor. This is a price level where the market has trouble falling below. Resistance slash ceiling. This is a price level where the market has trouble breaking above. Trend. This is the general direction the market is moving. Side note, remember this, the trend is your friend. Never trade against the trend. Uptrend, a series of higher highs and higher lows. Downtrend, a series of lower highs and lower lows. Swing high. This is a peak on the chart where the price went up, hit a point, and then started coming back down. Swing low. This is a valley on the chart where the price dropped, hit a low point, and started heading back up. FOMO, short for fear of missing out. Revenge trade. This is when you get mad at the market for taking your money and try to get it back immediately with a reckless trade. It's the fastest way for you to politely give your money right back to the market. Scalping. This is a style of trading where you get in and out very fast for small profits. Swing trading. This is for folks who want to hold trades for days or weeks. It's a slower paced ride, but if you got the patience, swing trading might be for you. Alright, that's the breakdown for part 1. If you can understand these basics, you're already ahead of half the people trying to guess their way through the charts. If this made sense to you, make sure you lock in for part 2 where we're going even deeper into the game. In the meantime, go ahead and follow me on TikTok. I'm putting out material constantly to help you move from a beginner to a boss. I'm Coach Allen, and I'll see you in the next video.